Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, the Chief Analyst at Wealth Within. Now this week I'm going to be sharing with you the remainder of my top 10 stock market tips. I'll also give you my views on the All Ordinaries Index and this week's stocks of interest that you've asked me to look at. Thanks for joining us. I'm sure you'll gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. Subscribe to our channel now so you can keep up to date. And remember to click that like button. Also remember to get on the Wealth Within live stream. The stock market show is on every Tuesday, 7 to 8 p.m. Australian Eastern Time. So let's get into this week's report. Now before I get into the remainder of my top 10 tips, I'd like to say thank you to all of those who have contacted me to thank me for my book, the tips I'm sharing with you on these videos, and how what we are doing is helping them with their portfolio and their confidence. I really appreciate you taking the time to get in touch with me. Let me again say right up front that getting better returns on the stock market is very easy. All you need to do is dispel the many myths that are holding you back, and this pretty much means do not pay attention to most of what you see, hear and read. As my book Accelerate Your Wealth says, it's your money and your choice. So let's get stuck into it. To remind you of what we covered in the first part of my top 10 tips, my first tip was don't dollar cost average. My second tip was that cheap does not mean you get a bargain. Number 3 was buy and hold really is not the answer to getting great returns. Now tip number 4 was to use leveraging wisely, and tip number 5 was another big one, and that was don't follow the herd. Interestingly, if you'd watched any of our YouTube live stock market shows this month, you wouldn't have to look too far into them to see that many, or should I say the majority of those watching, are not really following the tips that I've just mentioned. Now, I've been sharing tips like this for more than 2 decades, and I have 2 books that I get wonderful feedback on as to how they've changed the way people invest and how this has changed their lives. Now, the positive changes in returns, confidence and understanding that they report constantly amazes me. And all this from just a $30 book. Now you might ask yourself, why do so many get caught up in the myths rather than get into what we teach? Now it seems like a no-brainer to me in that after all, they will get better, more consistent returns. The simple answer is that most people are not playing to win, they are playing to not lose. What do I mean by this? Well, we've all seen a sports person or team choke, and in doing so lose. But prior to choking, they were winning. And so what changed? Quite simply, their thinking did. You see, they were no less talented or less fit. It was just their mind changed from playing to win to playing to not lose. And in playing to not lose, they got exactly what their mind was focusing on: losing. The majority in the stock market play to not lose rather than win. And in playing that way, they lose more and are inconsistent. Now it seems rather than pay for a $30 book that will help them, they prefer to surf the web, which has no risk and is free, in the hope of finding answers. They also won't enroll in a course that they know will show them how to trade really well and make consistently good returns, simply because they have to pay a tuition fee and do some work, when in contrast the web is free, they don't need to do anything and they're not accountable to anybody. Doing nothing or surfing the web for free means you're playing to not lose. It may seem to you to have no risk, after all everything is available on the web for free. That is until one day you work out how much you're actually losing in time, capital and lost opportunity. Remember, value is what you get, price is what you pay. Your education will cost you one way or another. Now, we constantly hear the excuses that I have no time and I don't have any money from those playing to lose. Yet these same people find several hours each week to watch YouTube and surf the web and attempt to trade thousands on the market. Even more scary, many attempt to trade foreign exchange. An excuse is just a lie covered with a skin of reason. Ask yourself, are you playing to win or are you playing to not lose? Then ask yourself if you will diligently follow my tips from today. Remember, it's your money and your choice. Buffett, the world's best and most famous investor, has some awesome advice, and yet the majority, those playing to not lose, do not follow him. Yeah, silly, I know. Like Buffett, I'll keep sharing with you, and hopefully some of you will take notice. And if you do, you'll benefit. Tip number 6, we talked about it on our Wealth Within Live program this week, and that was to always use a stop loss to protect your capital. A common misconception is that you only need to be armed with the knowledge of how to pick the best trades by having the best new tool, indicator, algorithm, or other technique to buy. But this ignores the most important area in gaining great returns, and this is knowing when to exit. One of the most important aspects to successfully trade in the stock market is to protect your capital every time. We do this in the event that the share price moves against you, and so it's imperative that you calculate and apply a stop loss before entering every trade. A stop loss is simply a price point where you sell a stock to preserve your capital if the trade turns against you. I always recommend that you use a stop loss of 10 to 15% depending on the volatility of the stock. You also need to manage your risk from investing in the market. From experience, I can say that if you follow the golden rules outlined in my book, you will significantly reduce your risk and achieve greater returns than the majority in the stock market. Now, all too often people say to me that having a stop loss of 10 or 15% is too much to lose. Have a guess if these same people are playing to win or playing to not lose. Yep, you guessed it. They are playing to not lose. And yes, they set their stop losses way too tight, and in doing so get more losing trades. They pay more brokerage than necessary and lose a lot of money. Now this brings me to tip number 7, and that is buy only top quality shares. So what do I mean by that? Well, quite simply the biggest and most liquid stocks on the market and not the smallest, most illiquid. This is the top 50 to 100 shares by market capitalisation. Why? They are consistently the best performing stocks in the market, as this is exactly how they ended up in the top stocks. Given this, it makes sense to stick with a good, proven performer. Unfortunately, too many believe blue chips are boring and slow in generating returns, and so instead prefer to take higher risks by investing in penny dreadfuls, just like many that we're seeing each week people asking us about on our live show. Now, contrary to popular belief, if you invest in top quality stocks and take a low risk methodical approach over the long term, you will achieve far higher returns and do so quicker than if you try to beat the market by picking the next boom stock or investing in penny dreadfuls. The sad thing for me is that most watching this video will not listen to this advice or follow these tips with the misguided belief that they actually know what they are doing and that they will not lose. Madness, yes. Playing to not lose, definitely. It is vitally important to understand that it is not how much money you make on any one investment that makes you wealthy. It is how much you do not lose over time. Buying speculative stocks in my book is quite simply gambling, not trading. Nothing is more certain to me that if you get a big win on a stock, that the market will take it all back from you in the future, and usually more. Tip number 8 is to trade well and not often. It seems that today more than ever, when I talk to people who want to learn how to trade, they tell me that their end goal is to day trade for a living. When I ask what day trading means to them, I usually get a myriad of responses based on ignorance, as all too often individuals fall prey to the myth that trading more often means that they will make far more money. In reality, the opposite rings true. They make less and spend more time doing it. There are a couple of reasons for this, and the first is that many people are taught to trade using daily charts. But this is like having your face planted up against a brick wall. You are unable to see the bigger picture of what is actually unfolding on a stock or in the market. And this is like driving towards a cliff, not knowing the cliff is there because you're looking at your phone. From experience, individuals who trade less using weekly and monthly charts make far more money, do less work to get it, and experience far less stress. Now that's a win, win, win in my book. The other reason why they attempt to day trade is that the broking industry gets paid when you trade. The more you trade, the more they make. So it's not surprising that every broker is prompting you to trade more through supplying information, live data, reports, and all manner of areas so that you buy and sell more often. They make even more money if you trade FX and other highly leveraged markets. But let me ask you, what's your goal? To make money for yourself or for the people who are self-interested in you trading? Trade less, make more. It just makes sense. Tip number 5 is to diversify, but not too much. We've all heard the saying, don't put all your eggs in one basket, and there's a good reason for this. Quite simply, if you put all your money into one investment and that investment turns sour, then you stand to lose all your money. Therefore, it makes sense to spread your money across different asset classes. Many in the investment industry also suggest that you should over-diversify within an asset class to minimise your risk further. Unfortunately, in the stock market, this can not only dilute your returns, but increase your risk, along with condemning you to investing mediocrity. If you want to get better returns in the stock market, it makes sense to simply get rid of the stocks in your portfolio that are going sideways or down. After all, we only want to hold stocks that are rising in value, don't we? Assets that move sideways or fall in price have a negative effect on your overall ability to create wealth. If a stock is falling in price, it increases your risk and reduces your overall returns. Therefore, holding these types of assets should be minimized, if not eliminated. Now, this brings me to my last tip. So, tip number 10 is educate yourself. This should really be tip number 1, but I left the most important tip to last. Unfortunately, ignorance in the stock market is rife and is often very expensive. As I mentioned before, the majority play to not lose, as they make excuses that they could not afford a proper education. You need to remember, an education is not a cost, it is an investment. Something that is a cost depreciates in value, breaks, or you use it up. And an investment does the opposite, as it becomes more valuable to you. Most people are happy buying a car for $40,000 with a loan of 9 to 12% that in 4 years' time they'll sell for $10,000. Yet they avoid paying $10,000 now to get an education that will make them $40,000 or more ongoing for the rest of their lives. Crazy, I know. What is a lack of good education costing you? Let me ask you this simple question. Would you be confident giving someone else with your level of knowledge and experience all of your money to trade for you? When I ask this question to those who have read books or simply attended weekend workshops, everyone tells me they definitely would not. Think about it. This is essentially what you're doing. In my experience, anyone who believes they will make a lot of money quickly in the market based on little education or experience is on the fast track to going broke. A proper education will ensure that you stop losing and start making money consistently. It will also ensure you are trading to win and not playing to lose. Remember, it's your money and your choice. You can change the outcomes you get by making the right decisions today. Now it's time to get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Okay, it was another interesting week on our market. I was expecting our market to fall away again last week in a second move down, but it came back later in the week, and having a few early days down in the week, I thought, yes, this was going to happen, but it came back really well on Friday to close a little bit higher. So let's go and have a little bit of a look at the chart, and so you can actually see what I'm actually talking about here. If I look at the last bar on the chart, you can see there on this weekly chart, it opened at 6265, but it closed at 6280, so 15 points higher than it opened. It did have a low of 6221, but it wasn't quite lower than the previous week, and you can see here on the previous week it was 6215, so it was about 6 points higher last week. The low of last week was 6 points higher. Now, interestingly, I still think our market needs to come back, and you can see here how the close was a reasonable way off the top, but not too bad. The high was 6311. So it did come back about 30 points from there. But if we go and look at the daily chart, you'll see what I was talking about here, where we had earlier in the week the market moved down to that 6221 on Thursday. Then Friday it opened here, it took off for a bit, 57.9 points for the range for that week, but it did close a bit lower after opening high, so it's trying to push through. Now the interesting thing that I'm looking at, if I use my crosshair tool here, you see what I'm talking about here. If I look at the highest close, you can see here where that horizontal line is, all our closes pretty much for the last since around about here, they're all below this, and this is March. So we've had 2 closes above that level of that 6283 level. So all the closes and the highs and lows are all below that. So it's a bit of a resistance level at this point in time, where you can see all of the closes and all the opens are below that. Since what's that date there is the 8th of March, but really there was only 2 bars outside of that actually were above that level. But this next few days, as we move into this week, will really tell us the direction over the next week or two. Now, I still think the market does need to move through that 6132 point level. And I'll go back to the weekly chart just to show you. I still think it's got more movement down. And we may see a real sort of fall quite quickly on that. And it's not huge. We're only talking about a couple of percentage. So if I put my little tool on here, from where it's closed to down there, there's 2.5% roughly down to that level. So it's not a big move, but I'd still expect it should come down to that level. Not saying it has to, but if it doesn't, then that means the market is still going on a very fast momentum. And when the market's moving fast, it will eventually have a bigger fall when it does start to come down. So what I'm looking for now is more sustainable momentum on the marketplace, and that's why I'd prefer it to come back down to these sorts of levels here to start moving back up again in a more sustainable manner, which is much more less volatile but much more sustainable over a longer time, which makes people a little bit more happier. Obviously, there's a lot of good-looking stocks setting themselves up. So for this next week, over these next few days, just watch the market. I'd just see, as I said, if it does start to come down, it might come down to that 6132. But if it does start to move up through here and starts to get through this sort of level at 6350, then it will move through that other previous high back in August at 6481 as it continues to move up. But it'll be a fast move up. But as I said, we need to expect a bigger pullback after the second half of this year, possibly. And at this point in time, as I said, just sit back and wait for a little bit until we see a little bit more of this short-term direction to see where it's going to. But always plenty of time to profit. Now, let's get into this week's stocks. Now, I've got a few people who have commented on the video from last week. Now, some of these people, I did handle their questions on our Wealth Within Live, which is Tuesdays at 7 to 8 p.m. So I did some of these stocks last Tuesday, but I thought I would cover them in this report in case they weren't on. And secondly, because they did ask the questions on this weekly market report. So I'll just read those out. And I'll read them all in one hit rather than specifically or separately as we go through. I've got one from Apollo Sense. He said, your opinion would be gratefully helpful, sir, on the following stocks: DUB, WZR, SPT, long-time subscriber. So I gather Polo Cent is a long-time subscriber of the channel. So thank you very much for your support, whoever you are. I'm not sure what your real name is, but thank you very much for your support. We've got another one from Gregory Asmanis, who regularly posts and asks questions. Gregory, thanks for being a supporter of the channel. Thank you very much for that. Hi, Dale. Any opinions on Grange Resources? Regards. So, yeah, I did cover that last Tuesday night, but I'll have another look at that again today for you. Thang Nugent said, could you please do video analysis on BIN, which is Bingo, and SPT? Again, SPT was Polo Sense as well. They have been on the news a lot recently. Thanks. Interestingly, on the news a lot doesn't bother me when people are on the news is irrelevant to me when I'm looking at the charts. So it's one of those things that I find a lot of people, they make buying and selling decisions based on what they read in newspapers and see on the TV, and so it's one of those things that it causes people to make a lot of mistakes there. But we did cover that, as I said, on last Tuesday night's show. So if you haven't seen the recording for last Tuesday night's live show, please have a look at that. We've got the last comment is from William Jago. Now, I know William was on last Tuesday night. He said, "Hey Dale, I'm thinking of purchasing Synlait Milk SM1. It's begun an uptrend and looks bullish, and I would like to hear your thoughts on the stock. I will wait till the stock takes a breather for a couple of weeks, as it has risen for the past couple of weeks." Now, again, it gets down to what is an uptrend, and we can have a bit of a talk about that, and we did talk about it last Tuesday night, but all of these stocks sort of fit in roughly into the same basket with me, and that's really where I want to go to, looking at and showing people what some of these stocks have done. Is they're all more speculative, and they're sort of stocks. And what I find is when I get a lot of people looking at speculative stocks, or somebody sending me a lot more lower liquid speculative stocks, it's a real big sign that they don't really know enough and their education is lacking, because what I find those that are least qualified to trade the stocks actually trade them. So it's the upside down. The least amount of knowledge you have, the less volatile, safer stocks you should be looking at, like the bigger end of the town. The more knowledge and experience you have, then you can come back down onto some more of the lower cap stocks. But even some of the people we're looking at, some of the stocks we looked at last Tuesday were micro cap stocks, and most people shouldn't be trading those at all. But when you look at this one, Dubber Corporation, looking at your screen, if you look on the left, and I'll just put my little tool on here, you can see here the last 2 months opening in February. At one stage this was up 139%, but it came back down to about 87%. Now what happens is people get in to see this starting to move, then they get on chat forums and they see that people on the chat forum saying, hey, it's moved 100%, and then people start to jump into it. So the amateurs tend to come in en masse at the end of a run, not at the starts of the run. People people run on news or ramp stocks on news, and they put stuff out there to get people to buy. Now if you look at the right hand side of your chart, you'll see the volume here back here on February here. So we're looking at, the start of February. Here we go. That's the first week of February, 1.4 million shares. So that's right down where the start is here at this point in here. Now we see volume really start to take off. Now have a look at this one here. Is 5.15 million shares traded at 99 cents. Now this is this big bars here. So the biggest amount of volume is in the last few bars, only for it to see it last week pull back. And this pullback here is opened at $1, closed at 86 cents. So it's 14 cents from $1. So that's 14% it dropped last week from open to the close. And at one stage it was a little bit more than that. It had a low of 83 cents. So at one stage it was down 17 cents. But look at the volume. It's dropped off a bit on the downward side, because what a lot happening is people are looking for that stock, and so what's happening is people are now taking profits. Those who got in really, really early and ramped the stock are now taking their profits. So right now this is a stock that I wouldn't have my money near, and I think what we're going to see now is it'll probably have a nice pullback right back through here, and people that bought in these areas won't sell that stock because they think, oh, I've bought in, it'll come back, it'll rise up 100% again, and they'll sit on this stock, and it may even come right back to this 40-cent range. It may not. It may turn around and go the other way, and then you'll see volume increase, and people that shouldn't be in the stock will get into it. But again, it's a warning sign. Don't get in late. It really is. Okay, now look at the next stock. It's called WISR stock. I'm not sure exactly what it does, but this is even more illiquid again, and actually it's highly illiquid, this stock. And again, people mistaken volume for liquidity. If you think volume is liquidity, it's only one part of the calculation. It's not liquidity. Just because a stock trades 1 or 2 or 3 million shares a day or a week does not mean it's liquid. It's a real false myth that you guys have out there that's got a lot of trading. A lot of people are trading it because there's a lot of shares being traded. Doesn't mean it's liquid. Liquid has a lot of calculations within it, and this is an illiquid stock. And you can really see by all this gaps and all this stuff around through on a monthly chart, it's really liquid, this sort of stock. If we now go to the weekly chart, and I'll just bring that up, and we'll look at quickly at the daily chart in a second as well. You can see, look, this volume histogram on the bottom's hardly even registering until we start to move up through here. And you can see here, right down here, if we look at, let's look at this top bar here. And again, the amateurs buy at the top. They get in after it's already moved. Here's 29 million shares there. Here we got 53 million shares here. And the 29 million shares as people came in, and then it went south as people were taking profits, selling to all of those people who were ramped. They saw this stock take off like a rocket, so they were getting in late. And so people that were got in through here getting in late are now suffering the losses, and other people were getting here buying, thinking it's going to continue up, only for it to fall away. Now, it does look weak. Look over here. It opened here, pushed right up, came right back down again. 66.9 million shares. And people are thinking this is liquid. It's not. Then it goes back down to 8.3 million shares. Very erratic. I think this stock's going to keep going down. But let's look at this one over here. 335,739 shares traded in a whole week. That's very illiquid. Now, it's a 4-cent stock. You can see there, 4 cents. So what I did last week is I said to people, we looked at a micro-cap stock last week for somebody on our live channel or our live stream. And I said, get your calculator out and multiply the amount of shares traded times the share price. Now, this is a weekly chart. If you multiply 335,739 by 4 cents, you get a few $1,000s. It's not very liquid at all. It's highly illiquid, and so that's not exciting. And if you can move the stock price with what you're buying, then it's too illiquid for you. And looking at this, you can see how illiquid this stock is. Look at that. It's days where it's like, look at that, 22nd, the 24th, 25th. So there's a day missing. It didn't even trade here. So there's gaps around. It's not a liquid stock. It's not a stock you should be in. I think this is going down, and I think a lot of people that bought in here are going to lose some money. Now, it is one of those, as I said earlier on, that's a misconception with people that you can make a lot of money out of some of these stocks, and you could if you get it right, but most people get it wrong. Here's the other one we look at. We're getting a lot of people now on Split IT or Split It payments, which is the same thing as Afterpay. Now there's now about 4 companies doing this, so Afterpay's got a lot of competition coming in for this sort of financing lay-by type thing, microfinancing type things, and there's going to be a lot more hitting the marketplace, so it's going to be quite a competitive marketplace. Now this floated on the market back here, and people see it take off and they go, wow, I'll get in to make some money. And if we look over here on the right hand side here, looking at the weekly chart, and you can see here how it did really take off like a rocket, and we had 185% within about 1, 2, 3 weeks. But then look at that, it's fallen down 42% since then. If I just get rid of that, you'll be able to see the actual bars. You see this, people were getting in, and look at this. Here's your volume coming right in here, 135,000 shares on this week alone at the top. Whereas this one here is, how much is that? 92,000 as people were getting in trying to stagger profit. If we go back here, look at that, 114, 41, and what's that one there? 18 million shares and 24 million shares. So I think this is going to come right back down to this sort of 40-cent level. If it gets below that level at 70, what that level is there, 70-cent level. Some people will be sitting there waiting for it to come on back, and I think that was the comment we got from one of the people there. I'll wait for it to come back, and then to get into it. Again, I still think this one's a bit speculative at this point in time. I think I'd wait and sit back a little bit longer than that. Grange Resources was one we covered last Tuesday night as well, but again, an illiquid stock, but it is moving up at this point in time. You can see all this sort of picket fences, and this is the sort of stuff. And look at the volumes right here at the top. So right up in here, and you can see here that's had a bit of trouble getting through this sort of level. And now if I look at the monthly chart, you can see what I mean, and I'll bring up this little crosshair tool, and you can see a lot of issues around that 29-30 cent mark, and it's really not a stock that I would actually own or put in my portfolio at this point in time. And again, people buying this stock that really are just looking at reports rather than exactly what's going on. If this stock is a great stock, then the big end of town will be buying it, and they'd be putting it in, and it'd be going on nice uptrends, and they're not really doing that at this point in time. But that saying, I said it still looks all right. It may go a little bit higher, but I don't know how high it's going to go. And the point is, you've got to get out of it as well, not just get into it. Bingo is another one that's been brought up a few times over the last month or so by some of the people watching our YouTube videos. This stock just doesn't look good to me. It looks like it's going to fall away. It looks like it's going to go below that level down there at $1.30. It does look like it's going to continue to fall away. Again, I don't think, let me put some volume on this, and you can probably see the volume here. Look at that big volume spike right there. Massive at the bottom. 131 million, and it dropped right off. But you can see here most of this top volume was all up around this, the high volume was all up around this top here rather than when it was on its upward move. Again, saying the amateurs don't get in till the last little bit. They wait till everything's happened, and everybody else who's knowledgable's got in already. And then what happens is the the wise people are now selling out and taking profits and selling out to people who are trying to grab a bargain. There's an old saying in the marketplace is, and when a man with knowledge meets when a man with money meets a man with experience, the man with the money gets the experience, and the man with the experience gets the money. And that's how the market works. It's a transference of wealth from the informed from the ill-informed, and that's what's going on with these sorts of stocks. Last one I want to cover today, SM1, was by William. As I said, he looks like it's in an uptrend, and it looks bullish, so can I have your thoughts on it? It does look like it's in an uptrend, and you can see he's sort of a bit of momentum there. Right now, is it going to go through this previous all-time high at $12.28? Not 100% sure. A little bit bearish last week, but it did close up higher, above about halfway up that bar. So let be interesting to see if we do get a bit of a green bar this week and it starts to move up. Then I think we might be able to get through that, but I'm not sure how long this uptrend will last for. Again, massive volume going through last week at 1.8 million shares there at $10. So it's pretty good volume with the share price there. If you multiply that with your calculator, you're getting a lot better. So it's not as illiquid. It's a newer stock on the marketplace, so it's a nicer share from William in terms of that. I think it will turn into a nice A2 milk Bellamy's, but don't expect it to do the same types of returns as A2 and Bellamy. Remember, it's more competition now. China's slowing down. There's a whole range of other different metrics now than were around when A2 milk and Bellamy's took off. So at this point in time, just wait for the next week and see whether it goes up or down. If it does start to move down, then it may come down and challenge that low there at $7.40. But right now, I wouldn't be adding to my positions or getting into it. I'd just be sitting back if I was in it and having my stop loss set. So that's it for me this week. So if you do have any stocks you want me to look at in this report next week, you do need to put them below. Any questions you've got, also please do put those below. Subscribe to the channel. That's really important. So subscribe now. Like the video, please, and comment. And I'll see you tomorrow night on Wealth Within Live at 7 p.m. Tuesday. So good luck, good trading. Take care.